Hello and welcome to the Phoenix Housing Market Report for April of 2020. Okay, so we are a full month into this as far as when Arizona started to see things shut down, and things have been changing so much every day, it's been really hard to put something together. I'm going to call this one the doozy. We are in full-blown doozy mode, and you'll see why after reading and watching this. This will easily be the most in-depth report I've ever done, but I think the circumstances call for it. First of all, I think it's important to note this is not a housing crisis. This is a global pandemic, and housing is an innocent bystander, along with a bunch of other industries. So I'm not going to make any predictions. That's pretty much useless right now. However, over the last few days, I finally started to see something that resembled a pattern. The pattern that I see in most of the stats is a calm before the storm, a spike, and now I'm seeing a settling down. Others are definitely still on a one-way trend, and we'll get to those, of course. By the way, this is just Metro Phoenix. Obviously, there are global and national issues happening, and those impact what we're going to talk about, but most people watching this just want to know how everything is impacting us locally, specifically when it comes to home prices, number of sales, and whether it's a buyer's or seller's market. And we'll discuss the stats related to that, and it'll all come together nicely at the end. I'll even be using fancy charts and graphs so you're not staring at me the entire time. So first, we have to start with some X factors, and those are unemployment, consumer sentiment, the iBuyers, interest rates, and lending challenges. So unemployment, this has to be the major player here. How that rebounds after all this is over could be the biggest factor on how things end up shaping up. And I have no idea what's going to happen. No clue. But right now it's higher than ever, and it's still climbing. And the full impact won't even be known for a while here. So a lot to unfold there. Consumer sentiment. Now, forget about being a buyer or seller. Let's just talk about being a human. We all know that everyone has an opinion on what's happening, and depending on what your take is, you may or may not let things stop you from entering the market. And even if you were already in the market, your sentiment could determine if you stay in or if you end up hitting the eject button, which quite a few people have done. Next is the iBuyers. So beginning in March, mid-March, companies like Opendoor, OfferPad, and Zillow, they completely stopped purchasing homes in our market. And they were buying between 400 to 500 per month. Now, in some cases, they even canceled existing contracts. I'm sure that went over really well. But as you could imagine, that was going to impact the amount of listings jumping onto the market that would have sold directly to them instead. And also sentiment is going to affect that because some people might think the iBuyers know something we don't when they're just dealing with their own issues. So they still have some inventory to sell off, but who knows how or if they'll be back. Now we have interest rates. Now, before everything started to shut down in the US, the Fed, they made a knee-jerk reaction to the way the market was reacting to things in China. And so they dropped mortgage rates to the low threes, which was lower than most people, even myself, had ever seen in their lifetime. Now, as you would expect, the consumer reacted with refinances and purchases by the masses. Unfortunately, this created what one lender told me was a bowling ball in a garden hose. That one's from Tom Ross. Basically, it gave lenders too much business, and they were at the buffet station with a full belly, is what he said. So they spiked rates to deter any more business from coming in, and suddenly they were back in the fives. So complete negative reaction. Some buyers no longer qualified for their loans. It lowered demand for people who were in the market. So like, what is this rate all of a sudden? Now, I'm told the bowling ball is almost through the hose, and with that, rates are expected to go back down. So that would likely increase demand. Now, the last X factor is lender challenges. By the way, lenders are better at this part than me. I'm doing what I can with this part. But in addition to the abundance of volume, investors stopped backing some loan products. So a lot of lenders, they just stopped issuing jumbo loans. And in some cases, it was in the middle of a transaction. From what I hear, portfolio loans are gone altogether. Now, depending on the lender, you may only be able to get a traditional FHA, VA, or conventional loan. Combine that with the fact that lenders still have to pay the loans that the consumer is allowed to hold off on paying with the assistance out there, it's going to be tough for lenders. But talk to one, see what they got, go from there. Okay, moving on to the stats. Let's start with the buyers and sellers market index. So any housing market can be defined in one or two categories: buyer's market, seller's market. And luckily, my friends at the Cromford Report, who also provide all the included charts and graphs here, have what they call the Cromford Index. It takes into account all the necessary movement along with stats to determine which type of market we are in. Now, an index rating of 100 is considered a balanced market between buyers and sellers. So let's check it out. What are we looking at? So here we have a long-term chart of the index. Now, as you would expect, we have been in a seller's market for some time now, since the end of 2014. Now, take a look at what that bubble and crash looked like, by the way. That's crazy. You'll also see that the seller's advantage was really getting up there lately, well into the 200s and higher than any point outside of the bubble, which made people think another bubble was coming. Now, looking at this, you'd assume we're still in a seller's market, but let's look at the daily chart. So technically we are in a seller's market, but the trend is spiking downwards quickly, a couple of points a day. So we peaked at 240 in mid-March, and it has sunk to 195 as I'm writing this on April 15th. So you'll see this one chart is still in the spike mode with, there's really no signs of it slowing down yet. Okay, so now we're going to move on to supply and demand. So whether it's a buyer's or seller's market is typically a result of supply and demand. And to say the least, there are a handful of issues impacting that. And this is how we can break it down in a way that makes sense by addressing those stats. So this chart here goes back to 2001. Now, once again, you can see what the bubble looked like, still crazy. Since then, demand has typically been higher than supply, and sometimes by a bit. And this is what we can attribute our appreciation rates to, which have been the most aggressive in the nation, or at least among the most aggressive. Now, what I take from this chart is that we still need supply to increase and demand to decrease quite a bit to balance things out, let alone create a buyer's edge. But you can see right here the gap is closing. And now let's get into the factors that impact supply and demand. The first one is active listings. Now, before everything happened, you'll see by this chart, we were seeing the lowest amount of inventory in years. This chart goes back to 2016. So recently there were actually more homes under contract than there were for sale, and we'll get into that. So once things began to take hold with COVID-19 though, listings spiked by 2,400 in 10 days, and it looked like it was going to go nuts, but that fizzled out. We only saw 1,000 more listings over the following 15 days and have dropped a bit in the last couple. What's crazy is that even with that increase in listings, we still have almost 5,000 less homes for sale than we did this time last year. So hardly the influx in listings that would have, really turned the tables on supply and demand. In addition, we saw a lot of activity come from buyer cancellations, see the X factors above, and owners of vacation rentals who suddenly saw the revenue from the best season of the year, March and April and February, for short-term rentals. It was gone, like their money was gone. So they jumped ship and listed their homes. Now, canceled listings was another form of supply influx, and both sides, the sellers and buyers both did this. And you'll see by these numbers, we are seeing a spike of cancels, and April's on track to continue that. But what's interesting is the spike we just had was still lower than the amount of cancellations we had this time last year. Tells you how strong things were for sellers lately. Now, this chart here is listing success ratio. Now, this tells us the percentage of homes that close with a sale instead of a cancellation or expiration. Now, once again, we see a drop in the amount of successful listings, of course, but looking at the long-term chart, you still have to go back to 2014 and 15 to see numbers lower. And April isn't over yet, so this is going to change. Now, something to note here is that we have never seen home prices fall when this is above 65%, so we have a little ways to go. Now, contract ratio, this is a measure of demand. It divides homes under contract by homes for sale. The higher the number, the higher the buyer activity. Now, you'll see what I was talking about in March when I said we had more homes under contract than we did for sale. That's how we got above 100. Now, looking back at the long term, you'll see how we went to a frenzy back to hot. So the drop from March to April can be misleading, to say the least. We're still definitely a hot market from what it looks like. Now, number of sales, this is a good one. Now, the bottom line is homes are selling. And as March was strong, it was strong as ever. But look at how February, March, and April stack up over the last few years. Now, I know I said I wouldn't do predictions, but you'd have to imagine the number in April will fall a bit when it's all said and done, especially after considering the X factors mentioned above. So as of today, we have 2,558 homes sold in April, but most closings do happen at the end of the month. So if anything, this once again tells us just how strong of a seller's market we were in before the effects of COVID took over. And also how resilient the market has been so far. So, however, this data is a month behind, so April and May will tell a lot. Next is price reductions. So I think you can attribute this one to seller sentiment and of course the fallout of buyer demand and cancellation. So sellers saw less action from buyers and did what they could to sell. However, you'll also see that the price reductions hit a standstill. They could be related to Easter, which was last week, but looking at the total on April 5th, the spike from March 22nd to the 29th looks like a one-time thing. So median sales price, just about done here. Bottom line again, prices continue to climb. However, a lot of new listings are in the 400 and under category, so that might bring the number down a bit. If anything, one would assume that appreciation will take a hit, but who knows? In conclusion, what's crazy to think about is that only something like COVID-19 was going to slow us down. And it happened. I mean, I heard someone say that the Phoenix housing market is like a freighter, which is not easy to turn. And so far, it's being very resilient. It's definitely turning, though. So I still think unemployment is the main driving force behind how the market will behave. And who knows how long this will go on. But I know this was a ton of info. And trust me, it took me days to put this together. And that is after weeks of paying very close attention and scratching my head. So I really appreciate you taking the time to read this. Please share it with anyone you know who you think might find it interesting, and I will see you next time.